Many people will tell you that the ideal time to start saving for retirement is now. The sooner you start investing, the better. This is true because over time, money invested can grow exponentially. Hello and welcome back to the Finance Guardian channel. It might be new to you, but your approach to investing and how you aim to maximize your savings should change as you age. Over time, your income will grow and you'll want to increase your investment amount. Also, it will be best if you reevaluate your asset allocation as time passes. So here's how you should invest at every age. Hit that subscribe button and the bell beside it, and let's get started. What is asset allocation? Before you make decisions about investing at different stages of your life, it's important to understand the concept of asset allocation. In the world of investing, there are numerous asset classes, or in other words, investment categories. The main types of assets are stocks, bonds, cash, and cash equivalents. Other asset classes can be classified as commodities, real estate, futures, and derivatives. As with most things in life, every asset class has its own level of risk and reward, or return, as they usually call it. As a result, each class's behavior varies over time, depending on the economy and other factors. For example, investors are confident when the economy is booming. Their money is moved out of bonds and invested in stocks, where earning potential is much higher. In the same way, investors are less confident when the economy cools. Stocks are now seen as too risky, so investors take money out of them and seek the safety of the bond market. It is generally acknowledged that stocks and bonds are negatively correlated, but in the time of a financial crisis, that wasn't the case. Still, bonds tend to help smooth out stock market fluctuations for the most part. Some of you may ask why investors are doing that. Well, if you invest all your money in one asset class and that asset class plunges, you have no safety net to protect your capital. Investing in a range of asset classes diversifies your portfolio. If one asset class does not perform well, diversification prevents you from losing all of your money. Asset allocation describes how you arrange the assets in your portfolio. There is a wide variety of asset allocations recommended for different ages and requirement horizons, so consider consulting a financial professional to help you build your portfolio. How much money should you save at every age? It's easy to think that once you figure out your investment strategy, you've found that perfect balance and that you're good to go, but that's simply not the case. Our tolerance to risk decreases when we get older because we don't have decades to recover from losses we might incur. For example, we are more likely to bounce back from a loss when you're 20 than at 60 if a stock you're investing heavily in suddenly loses value, because you still have decades to take advantage of the stock market and invest in other potential high-performing assets. It is also important to note that your investment strategy should be tailored to your unique goals and circumstances, and you should consult a financial advisor to help evaluate your financial situation and develop an investment plan. Investing in your 20s. Even though you just graduated from college and may still be paying off student loans, now is the right time to begin investing. Whether it's a company 401k or an IRA you set up for yourself, don't worry if you cannot contribute to the 10% recommended amount. Invest what you can. Traditional IRAs and Roth IRAs each have an annual contribution limit of $6,000 for 2022, according to the Internal Revenue Service, the IRS. Some 401k plans offer matching contributions from employers, which means they'll contribute up to a certain percentage of your salary to your plan. The maximum contribution you can make to a 401k in 2022 is $20,500. Your most significant advantage in investing right now is time. Over the next decade, compound interest will allow you to make the greatest possible return on your investment, and you will have more time to absorb changes in the market. Investing in your 30s. When you don't have a 401k or would like to contribute more funds to retirement, you might want to consider a Roth IRA. When you meet specific income guidelines, you can invest up to $6,000 after tax or $7,500 if you're 50 or older. In contrast to a 401k, Roths grow tax deferred, and if you withdraw the funds in retirement, you won't owe taxes. On a different note, stocks have outperformed bonds and cash regarding long-term returns. From 1928 to 2020, the S&P 500 returned an annualized 10%, the 10-year Treasury bond earned 5% per year, and the 3-year Treasury bill yields 3.35%. Even though bonds are more stable, their returns are unlikely to beat those of stocks. Stock funds can make up a significant part of your portfolio if you are relatively risk-tolerant, while bonds and cash investments can make up a remainder. You can choose a target date mutual fund if you prefer a more accessible option. As you age, these funds automatically rebalance, becoming increasingly conservative as you approach retirement. Another thing is that you might consider purchasing a home. it may be a good idea to consider investing in a REIT or a rental property. Low interest rates can make buying real estate particularly appealing when you don't live in a costly housing market like New York City or San Francisco. Investing in your 40s. In case you're late to the savings and investing game, you can catch up by making some lifestyle adjustments. Prepare for retirement by boosting your savings and investments. Do not wait any longer to contribute to your employer's retirement plan. If you've been investing in a 401k, increase your contribution to the maximum per year. Your asset allocation in your 40s may be slightly more inclined towards lower risk bonds and fixed investments than it was in your 30s. An investor with a conservative, risk-averse attitude may be comfortable with an allocation of 60% stock to 40% bonds. Remember that the more stock holdings you have, the more volatile your investment portfolio will be, and the greater the risk you will face. You can keep your investing costs down by sticking with index funds that charge low fees. It's also possible to mix internationally diversified stocks and REITs in your investment mix. Investing in your 50s and 60s. Your retirement age is drawing closer, so now is not the time to lose focus. Your retirement savings will need to be more conservative as you approach retirement age if you have invested your money in hot stocks during your younger years. Investing in more stable, low-earning funds like bonds and money markets might be a good idea if you do not want to be risking all your money. Also, now is the time to look at what you have and think about when you might be ready to retire. It can be beneficial to seek professional advice if you want to feel secure about walking away at the right time. Another option is to catch up by putting more money aside. The IRS allows people approaching retirement to invest a more significant portion of their income. A catch-up contribution is an additional $6,500 per year that workers aged 50 and older can contribute to their 401k. And the 2022 contribution limit for traditional or Roth IRAs is $7,000 if you're over 50. Investing in your 70s and 80s. You're probably retired or will be very soon, so you should shift your focus from growth to income. However, don't cash out all your stocks. Invest in stocks that provide dividend income. You will also likely start collecting Social Security retirement benefits if you have one. Don't forget to take your RMDs on time, as there's a 50% penalty for not withdrawing your money on time. You don't have to take RMDs if you have a Roth IRA, so you can leave the money to grow for your heirs. If you're still working, you won't owe RMDs on your 401k at the company where you work. As the traditional IRAs, you can still contribute to them if you have eligible earned income that doesn't exceed the IRS income thresholds, thanks to the Secure Act passed in late 2019. Additional income streams. Don't forget to take advantage of your investments to create income streams. Make some of your investments in higher dividend-paying stocks and bond funds. You may also want to consider REITs with juicier dividend payments, or you could also invest in businesses that generate passive income. This will enable you to have some spending money in retirement if you structure your portfolio appropriately, and it will also add to your financial security. The bottom line is, whatever your age, the best time to start investing was a while ago. However, it's never too late to start. Make sure your decisions are appropriate for your age. The investment approach you choose should keep pace with you. And don't forget to speak with a qualified financial professional who can let you know where you stand and what you need to do. This is all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit the like button. If you're new around here, subscribe to our channel to remain updated about all our future videos. We'll see you next time.